Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include lock percentages, my interview with National Community Reinvestment Coalition's Josh Silver on ending redlining through a community-centered reform of the Community Reinvestment Act, and why mortgage rates continue to drift in their range.
Are you looking to cut verification costs by up to 50% while improving borrower experience and pull-through? TrueWork helps lenders streamline income and employment verification through a single VOIEA platform used by 4 of the top 5 lenders. With an industry-leading 75% completion rate, the platform consistently outperforms competitors in manual waterfalls in speed, cost, accuracy, and rep and warrant relief. They also offer free pre-approvals to help your borrowers qualify faster and only pay when a file is completed. It's used with first and second liens as well as in wholesale. It's fast to implement, easy to use, and built to drive ROI. Learn more at truework.com.
Don't forget to snag your free Slurpee today at participating 7-Elevens. Speaking of edible things, I like my Frosted Flakes, Fruit Loops, and Raisin Bran. Well, Raisin Bran if there's nothing else available. M&A is not confined to lenders, so imagine my surprise when I learned that Michigan's W.K. Kellogg Company is set to be acquired by the Italian candy maker behind Ferrero Rocher in a nearly $3 billion deal. Sometimes it's hard to track who's doing what and how it impacts us. But tracking locks is important. The locks that Optimal Blue tracks increased 2% in June. Non-QM locks account for an increasing percentage of total volume, rising 7% over the month. The steady rise in this category reflects the industry's growing focus on flexibility and meeting borrowers where they are. According to Kiranos' new proprietary application index, refinances decreased 21% week over week and increased 17% in June. The purchase index decreased 19% week over week and decreased 2% for June as a whole. June 2025 funded mortgage volume increased 15% year over year. Markets still anticipate at least one Fed rate cut by year-end, though a move in July now appears off the table. With the tariff deadline pushed to August 1st, investors are closely monitoring trade developments, but are holding off on major shifts in positioning until there's more clarity. From the Fed's perspective, the labor market is seen as tight, inflation remains elevated, and ongoing tariff uncertainty could all influence the policy outlook. We learned yesterday that jobless claims fell to 227,000 for the week of July 5th, marking a 4th straight weekly decline and signaling continued labor market strength, with the 4-week average also easing and continuing claims rising slightly in line with expectations. The data pushed 10-year yields slightly higher to 4.35% as attention shifted to the upcoming long bond auction later in the day. Speaking of which, yesterday's $22 billion 30-year bond auction offered a solid read on investor appetite for long-term debt amid ongoing concerns about deficits, trade tensions, and rising interest costs. Despite recent skepticism around duration, the bonds sold at a slightly better than expected price, with strong demand, especially from buyers outside of primary dealers who took 87% above the recent average. The result helped ease upward pressure on yields and reinforce Treasury's safe haven appeal, suggesting that markets are shifting their focus from fiscal worries to economic fundamentals and Fed policy. The auction capped a week in which $119 billion in new supply was smoothly absorbed, signaling steady demand. For today's interview, I wanted to welcome to the show National Community Reinvestment Coalition's Josh Silver to talk about ending redlining through a community-centered reform of the Community Reinvestment Act. He's widely regarded as the nation's leading CRA authority and came out with a book that offers the definitive guide to what the new rule means for cities, neighborhoods, and the future of racial and economic justice. With the law's 50th anniversary approaching in 2027, he makes a powerful case that CRA modernization can finally live up to its original promise, which is to end redlining and build stronger local communities.
I want to start by talking about changes to the Community Reinvestment Act, and I've seen some stuff out there. It's about to change dramatically. Federal regulators are overhauling rules, and for people that might not be super aware, the CRA governs how banks serve low and moderate income communities. It looks like there's some rule changes expected in January 2026. I'm very pleased to have you on the show. Josh, can you talk about what's changing and why it's so important?
Sure. Well, first of all, just a little background about the Community Reinvestment Act. It was passed by Congress in 1977 to outlaw redlining, or the refusal of banks to serve basically communities of color. And the way CRA is implemented is the law requires federal bank agencies, there are currently three federal bank agencies that conduct CRA exams and give banks a report card and a grade, if you will, on how many loans, investments, and services they're making in low and moderate income communities. And the best grade is outstanding, then satisfactory is like a B, and then there's two failing grades. If you fail and you're a bank, you might have trouble merging or acquiring another bank when you want to in the future. So that's kind of the penalty for CRA. And the regulations covering CRA is basically what it boils down to is what is on the CRA exam. What type of lending activities, for example, are looked at on the CRA exam. During the Biden administration, there was a major reform of the CRA regulation. The rule was finalized in 2023. And just to give your listeners a sense of this, one major reform was CRA was passed in 1977 when most lending was done around bank branches. Well, as you know, there's something called the internet that came about subsequently to 1977. So there is a lot of bank lending still around branches, but there is increasingly more bank lending going through the internet or by mortgage brokers. So how do you consider loans on CRA exams that are beyond the branch footprint? And the 2023 regulation did that. For example, if there was a lot of lending activity in Illinois, the CRA exam would look at the lending activity in Illinois and grade it. And there were very other important ways that CRA was updated in 2023. The last major update was 1995. So we were long overdue for a CRA update. Well, elections, fast forward, elections have consequences. And the new Trump administration has announced that it is going to rescind the 2023 regulation. The CRA law will still be there, but we're going to go back to basically 1995. And for many reasons we can get into, I don't think that's a sustainable future for CRA because there is something called the internet, for example.
When it comes to why it's taken so long to get these, I mean, the rule's been around for 50 years or so. You talked about some reforms there under the Biden administration. I believe that was 2023. But for the CRA, why is it taken so long to update how we evaluate banks' commitments to underserved communities?
One thing that's going on is to update a regulation, you have to have all parties buying in. The parties might not be totally happy with the outcome. When you have any law or regulation, it's basically a compromise, like a compromise in a marriage, if you will. Not only banks, but there is community organizations. I spent my career working at the National Community Reinvestment Coalition, which is a coalition of 700 community-based organizations around the country. Think of housing counselors or small business technical assistance providers. And the banks have their own trade associations. So one reason it took so long is there was not a consensus for CRA reform. And during the first Trump administration, there was a fellow leading the Office of the Comptroller of Currency named Joseph Otting. And he went out on his own. He actually broke away from the Federal Reserve Board and the FDIC. This was one of the few times in CRA's history there was actually a break among the three regulators. And Joseph Otting did his own rule. And the reason I mention this is the rule was so bad and so oversimplified that neither banks nor community organizations liked it. I don't remember a time in my career when I was reading a letter from the American Bankers Association and agreeing with most of it. And so I thought in the wake of that experience, maybe there would be a possibility of at least some commonalities between the banks and the community organizations. And the agencies really tried hard in 2023. First of all, the rule was a multi-year process, and there was many opportunities for commenting by both the industry and the community organizations. But we got the final rule in 2023. And what do the bank trade associations do shortly after the rule is final in the Federal Register? They sue. So again, still a lack of consensus. So that is, anyone can pick up the paper and read that America is increasingly polarized. And so we need to really increase dialogue between banks and community organizations, because I think we have to, I talk to any bank one-on-one and they will say, yeah, we can't live with CRA as it was in 1995. There was a lot of good things about the 1995 rule, but we live in the world in 2025. So I think that there's going to have to be effort by all the stakeholders, regulators, banks, and community organizations to really sit around the proverbial negotiating table and figure it out. And I'm glad you're doing this interview, because hopefully this gives people some ideas that we need to really come together to have a durable. It's a good law. It's a law that makes capitalism work in all communities. It is as American as apple pie. Make capitalism work in communities of color as well as white and affluent communities. Give that small business owner a chance who's working hard and playing by the rules. Give him or her a chance for a loan. And CRA has opened up a lot of doors for profitable lending opportunities that were overlooked before. So if you look at that way, I hope making capitalism working better in all communities. I hope there is some bipartisan buy-in and buy-in by the major stakeholders that are affected by CRA in the future.
Yeah, I agree that it's a well-intended law. We're almost 50 years from when it became. I mean, we're almost at the CRA's 50th anniversary here. How close or far are we from the law's original vision, which was essentially ending redlining, fostering racial and economic justice through reinvestment? And how much has it changed, or how much has the intent of the law been able to keep up with modern times? A lot of banks don't rely heavily on physical branches anymore.
Right, and that's why I opened up talking about how do we look at lending through the internet. And I think the spirit and the intent of the law has been enforced over the years. There has been progress in lending and investing in low and moderate income communities. There was a study done by the Federal Reserve Bank of Philadelphia, an economist over there, that when a census tract loses CRA eligibility, it goes from low and moderate income to middle and upper income, lending can decline by 10% or even higher. So it does push lenders to work harder in low and moderate income communities. We are talking about literally billions of dollars of investments, like equity investments in small businesses and the low income housing tax credit. That's one of the major vehicles for affordable housing in this country. A lot of your listeners are familiar with low income housing tax credits. Really, literally billions of dollars every year. So there has been progress, but you're right, to keep the spirit focused on underserved communities. And there has been technological changes in banking, not only the internet, but underwriting has gotten a lot more automated. How do we take into account that development for a population that a lot of people are creditworthy in the lower income population, but they may not have credit histories that are as well established as yours or mine. And can automated underwriting take that into account, or do we, for some people, we still need to do manual underwriting and high touch lending, if you will, working directly with the loan officer? So, these are the conversations. CRA still needs to take into account things like internet and automated underwriting to make sure it stays vibrant in future years.
I was fortunate enough to go to MBA's advocacy conference in Washington, D.C., and I saw firsthand the power of advocacy, or making sure that your voice is heard. In this case, communities' voices are heard when it comes to influencing how banks meet their CRA obligations. Can you speak a little bit to advocacy, to communities speaking up and standing up for what's best for them, and just what it can lead to?
Sure. And one reason why we were inspired to do this interview is I just wrote a new book called Ending Redlining Through a Community-Centered Reform to the Community Reinvestment Act. Just remember, ending redlining. But the reason why I say community-centered is community groups have to have a prominent place at the negotiating table. And one place where this occurs is when banks want to merge with each other. The agencies have to look at the CRA record of both banks and make sure that future performance is going to be just as good or better. And this is a place where advocacy comes into being. Mergers are very complex. You've been in the financial industry. When two institutions merge, decision-making changes, personnel may change. Will the CRA officer that is really doing a good job in San Diego keep his or her job? I mean, things as mundane as that, but as important as that, get worked out around the negotiating table. And one thing that happens is community organizations and banks negotiate what is known as community benefits agreements. Banks have to demonstrate a public benefit by law when they merge. So isn't it a public benefit? We are going to make more loans and investments after the merger than we made before the merger. So one statistic, since 2016, NCRC and its member organizations have negotiated 22 agreements with banks for a grand total of $588 billion. These are large banks, so they make billions of dollars in loans, but this $588 billion represents an increase in lending than before the mergers occurred. So this is, to your point about advocacy can make a difference. This is dollars in low and moderate income communities, and it's probably made the difference between some, economically thriving communities and communities that are experiencing economic distress.
Yes. And we live in rapidly evolving times. I'm pleased that we've gone this far in the interview without mentioning AI so far. It seems like that's all people want to talk about. But in general, we're seeing a rise of fintechs and non-bank lenders, and they are helping to shape the mortgage landscape, the credit consumer, or the consumer credit landscape. They're excluded from CRA regulation. I'm wondering what the consequences are of that, and any reforms that you would recommend that could help close that gap out there.
Well, I'm an advocate for extending CRA obligations broadly throughout the financial industry, whether you have a quote unquote fintech that's not a bank, or insurance companies. Insurance companies have had their own history of redlining, unfortunately. And I think it can be done. I talk about some efforts in Congress in the 2000s in my book, Ending Redlining. We haven't seen that on the federal level, but on a state level, in New York and in Illinois. Massachusetts is the oldest state CRA law. But the reason I mention these states is not only do they have CRA for banks, they have CRA for mortgage companies and credit unions, mainstream. Some large credit unions don't have a great record in lending to people of color, for example. And CRA in Massachusetts has been doing CRA for credit unions and mortgage companies for years. It's time to have these conversations. And the bank trade associations quietly support efforts to extend CRA, particularly to large mainstream credit unions. So I think you'll get some industry buy-in on some of these ideas.
Yeah. The more buy-in there is, the more disagreement there can be, though. And I think we've seen that where some people are saying, the new rule doesn't go far enough to address racial disparities in lending. There's banking groups that are saying this is making for an increased compliance burden. How do we find a proper balance between these things? Because we want meaningful impact, but we want manageable implementation as well.
Well, I think that's why conversations between the stakeholders is very important. In the 2023 regulation, there was some more specificity, for example, on the lending test. What merits an outstanding rating or an outstanding score on percent of loans to low and moderate income communities? And the agencies actually tried to put in numerical thresholds. Like if a lender was doing if its loans was 15% higher than the industry average, for example, that would get them to outstanding. It's interesting because some banks for years are saying, we want bright lines like that. We want to have targets like that. But ironically, there was some industry pushback on that particular aspect of 2023 rule. My response is, I was a fan of the thresholds, but if you don't want the thresholds, you got to have something better than 1995. 1995 was, well, outstanding score on the lending test if a bank is just making a high percentage of loans to low and moderate income communities. How do you measure that? On CRA exams, you compare a bank against its peers. Okay, you should get an outstanding score if one bank has a higher percentage of loans to low and moderate income people than its peers, for example, not just a high percentage. That doesn't really mean a whole lot. And there's also some demographic benchmarks that are used in CRA exams. So if you don't want specific numerical guidelines, there should be some guidelines that tell you about scores when you are in a certain position related to your peers, if you're above or below your peers, and how far above your peers are you, for example, and also to the demographic benchmarks. I think, if you get some reasonable representatives, both stakeholders around the table, I think we can flesh this out. Maybe I'm naively optimistic, but I want to give it a shot. Maybe not during the next 4 years, but hopefully in the future.
Yeah, I do think at some point that day will come. Pleasure speaking with you today, and best of luck promoting the book and getting the word out there about something that's really important to the industry. So thank you.
Thank you. A pleasure speaking with you today.
Mortgage rates rose for the first time in 6 weeks following the stronger than expected June jobs report. For the week ending July 10th, the 30-year and 15-year mortgage rates in Freddie Mac's primary mortgage market survey rose 5 basis points and 6 basis points, respectively, to 6.72% and 5.86%. However, those mortgage rates are 17 basis points and 31 basis points lower from a year ago. Today's loan data point is the June budget statement from the Congressional Budget Office, due out this afternoon. Estimates are for a surplus of $26 billion compared with the $71 billion deficit in the prior fiscal year. Without any meaningful data, we begin Friday with agency MBS prices a shade worse than Thursday's close, the 2-year yielding 3.88, and the 10-year yielding 4.38 after closing yesterday at 4.35%. Let's wrap up with a joke and some housekeeping. It's the month of July on the shore of Lake of the Ozarks. It's raining, and the little town looks totally deserted. Which, I think the little town's Branson, Missouri. But anyways, it is tough times, everybody's in debt, and everyone lives on credit. Suddenly, a rich tourist from Connecticut comes to town. He enters the only hotel, lays down a $100 bill on the reception counter, and goes to inspect the rooms upstairs in order to pick one. The hotel proprietor takes the $100 bill and runs to pay his debt to the butcher. The butcher takes the $100 bill and runs to pay his debt to the pig grower. The pig grower takes the $100 bill and runs to pay his debt to the supplier of his feed and fuel. The supplier of the feed and fuel takes the $100 bill and runs to pay his debt to the town prostitute that in these hard times gave her services on credit. The prostitute runs to the hotel and pays off her debt with the $100 bill to the hotel proprietor to pay for the rooms that she rented when she brought her clients there. The hotel proprietor then lays the $100 bill back on the counter so that the rich tourist will not suspect anything. At that moment, the rich tourist comes down and, after inspecting the rooms, takes his $100 bill, after saying he didn't like any of the rooms, and leaves town. No one earned anything. However, the whole town is now without debt and looks to the future with a lot of optimism. That's also how our United States government does business today.
Thanks again to TrueWork, the only all-in-one automated VOIEA platform that helps mortgage providers achieve up to 50% cost savings with an industry-leading 75% completion rate. To learn more, visit truework.com.